Actually, Sourceman here. It's June 9th, 2022. I thought I'd just make a few comments about position sizing. I get asked that a lot, and when are you updating your top holdings, etc. Uh, Typically, I don't like to do that. I've showed approximately the position sizing of some hodl portfolios I manage. Where you have above 5% holdings and sub 5% holdings, etc., across 30 or 40 holdings. As you well know, I'm very diversified because the larger my portfolio has become, it's let's say feels better and better to spread out the bets. uh, and I just want to highlight a few things when it comes to what is actually important. I mean, you all the time you see people brag about one trade or two trades or throw shit at people when they have a stock that's done badly, or many stocks that's done badly, etc. I mean, the most important thing is obviously your long-term portfolio returns. It's not what your portfolio is doing at a sentiment bottom. It's not what a portfolio is doing at a sentiment high. It's your long term results, which are based on, if you're going to have good long term results, you should have a very good strategy. Otherwise, it will be very hard to have said results. And typically, I mean, your investing strategy is a bit theoretical because you can't know what the actual returns will be. So you have to come up with a strategy that makes a lot of sense, and in 10 years or whatever, or at least in a it takes several years to really get an appreciation how well you're doing, because anybody can be quote unlucky or lucky in a period of time. And of course, at sentiment bottoms, everything typically is down. At sentiment tops, everything is typically up, regardless of what your strategy is, pretty much. The most important thing is, of course, what you do at those bottoms and tops, because that's gonna set you up for the future. Like right now, for example, I mean, I think selling is stupid because everything is so cheap, and the expected returns going into the future are so high. So it doesn't really matter what your portfolio has done over the last year, year and a half, or whatever. It's your long-term results that matter, and this is why it's so important to think right at bottoms, because that's when uh, typically, I mean, mistakes get exponentially high. Because as we know, a stock can only go to zero minus 100%, but a stock can also go infinitely high. So obviously, the ramifications of what you do at bottoms typically are way more important than what you do at the tops, and it's typically, well, most people do mistakes at the tops and the bottoms. Uh, but furthermore, uh, like everyone, especially if you're kind of semi-public like myself, I guess I'm involved with a bunch of companies. I own a bunch of stocks at a sentiment bottom. Like now, almost every company will be down over the last year, down considerably from the 52 weeks highs, and that comes with the territory, especially if you're quite diversified like me. I mean, sure, you can be in three stocks, and let's say those three stocks do well. So at surface, you're like, yeah, man, this is going very well. I'm killing it. Yeah, but uh, the results, like always, tell only part of the story. You don't. If something, we have no idea what can happen. We just know what has happened. In hindsight. So if you do well being concentrated in three stocks, that's gonna be good, for example. But that might, teach you to just stick to three stocks all the time, and then something happens in two of the stocks, and you could be pretty much obliterated, let's say. So I mean, since we don't know what risks or what future will happen, you can't just look at what happened and then make a judgment call that yes, I made a good decision because it worked out. That's pretty much like going all in uh, with a random hand in poker. You don't even see the cards and you won, and you say, yeah, that was a good decision because I won. No, that's not how you do it. I mean, that's obviously very much gambling, and in a lot of cases you would lose with that hand, but that's not the reality you're in. You're in the reality where you won. So you automatically think that was a good decision, but do that enough times in a row and you're gonna lose. And if you know you have some bad variance and actually have pretty poor hands you go all in with, etc. Uh, in the end, you're gonna lose everything on a long enough timeline. And one thing I would also like to point out is that I mean I will have many losers, especially on paper, especially at sentiment bottoms. Right now, from 52 weeks highs, almost every stock I own, pretty much, is down at least, I don't know, to 20%, something like that. I mean, some are down way more. Uh, Average, who knows, 40-50%, something like that. So right now, I'm on paper. I've been losing money, and that's what most people can't comprehend. And typically, they think that you know can't have great long-term results. But I've shown this a couple of times that I've had I think 3 or 4 50% corrections in my entire portfolio, and the end result has still been very good because I don't do stupid things at bottoms. When they bottom, typically I shuffle well around the bottoms. I don't know when they bottom. I shuffle around, and it's like, let's say you have a company that goes down 50%, another company goes down 50%. One of those companies should be down 50% because the story has gotten worse. One company, the story has gotten better, shouldn't be down 50%. So if you shift from the stock that should have gone down because results were bad, and it is down 50% or even more, and you shuffle it into something that should have gone up 50% but is down 50%, that's opportunity arbitrage. Yes, you're selling something that's down, let's say 50%, and buying something that's down 50%. So at face value, you're like, well, I'm no better off because I just sold something at a 50% loss from 52 weeks highs to buy something at 50% loss from 52 weeks highs. Yeah, but investing is obviously all about the future. And at some point, the future will become hindsight, etc. So that's obviously a good move because you might make that back, the 50% loss in both, and then some, because the stock you double down in, it's going to go up 300% until the next sentiment high. And also, it's like I have a bunch of high risk, high reward stores. Not a bunch, but I mean I have a few, pre-discovery or early stage, etc. And of course, I'm gonna get flack for, let's say, owning and being bullish companies that are down right now from the 52 weeks highs because we're at sentiment bottom. And since let's say I own 40-50 stocks, and let's say 35 of them are down considerably from the 52-week highs. That's a lot of stones you could throw at me if you have no idea what I'm doing or have no idea about investing overall. Well, one important thing is like position sizing. I mean, I have a bunch, like I write here. I think my median position size is around 1 to 1.5%. So if I have 20 stocks, let's say high risk, high reward stocks, they could go down minus 100%, and that would be a 20% hit to my portfolio. Whereas, my top 5 companies uh, uh, might make up 40% of my portfolio. They would only need to go up 50% from here to pay for the 20 that went to zero. So it just always blows my mind when, uh, you know, in my case, for example, I own a lot of stocks, and we know this is a shitty business, high risk business. Uh, a lot of them will not be great successes, and almost every one of them will be down at a sentiment low. And then you get the feeling that people think again. It's like, yeah, you liked or you like or liked these stocks, and ramble off some names, and it's like, yeah, you can't be up, you can't be doing well, uh, you you must be losing, you have a losing strategy or whatever. It's like, I mean, look at some of my high conviction picks, for example. It's like SK Mining. Uh, got in around December 30, 2019. Yeah, 2019. Well, I don't know how big of a position I had back then. At least at 4th of August, know I had pretty much a full position. But let's say, around, I don't know, 25, 30 cents, somewhere along those lines. Uh, or let's say, yeah, let's say 40 cents. I mean, if that's a 5% position, I don't remember. I think I actually put in a 10% position later in the private placement, at least. I actually think it might have been more than that. Well, let's say 10% position. So if you go from like 40 cents to 80 cents, that's $1.5, $4 higher. I don't know exactly, I can't calculate that now, but let's say 300%. And at one point it was obviously up way more than that. I mean, it was double what it is now. So 40 cents going to 3.55 cents. I mean, SK Mining, pretty much at the peak here, was worth as much as my entire portfolio was valued in 2019. That's one stock, a high conviction stock. I put in a large position in SK. That paid. Every other company could have gone down to zero at the peak here, and I would be still even. So think about that. I mean, I could have been bullish and long 30, 40 companies. One stock is where I had, started with a 10% position, just let that ride. And that would have paid for 30, 40 stocks that would have gone to zero. So obviously, the more stocks you own, given this risky business, and especially given a sentiment low, there's gonna be a lot more you're gonna, the more stocks you have, the more companies will be down at a sentiment low. If you have owned 3 stocks, there's 3 stones to throw at you. So it's like, I have no idea how many of all companies I own that's going to be great successes. What I know is that I don't need many multi-baggers. Let's say 25% of my companies do well and I let them run. If they do 300%, 300%, that's gonna pay for every other company, and we know what happens from these sentiment lows. So it's like, I get tired sometimes, because I'm gonna have a lot of losers along the way, but I have a lot of 1 to 1.5% positions. The higher risk ones, and I don't expect all of them to do well. And especially I expect most of them to be down right now on paper. But it's the portfolio returns that matter. It's not. I mean, if you want to do an ego contest, like, yeah, I'm gonna be in one, quite high conviction stock. I'm gonna put everything in Franco Nevada or whatever. Sure, I mean, you might do okay. I'm not saying that the Franco Nevada has done well. But if the more money you have, typically the more stocks you'll have to own, and typically the more stocks you have to own, the more stocks will at some point or another be down. Especially, I mean, you could have 100 positions in 100 different risky juniors, maybe 20% do well and actually become, 500, 600 or 10 baggers or whatever. That's gonna pay for like, 80 losers or whatever. But you're gonna take a lot of flack, obviously, because most people can't fathom how you can't pick 100% winners and still do well. So it's like Loro is another example. Yeah, when did I started buying? Around, I guess, June 25, 2020. When was that? Yeah, I don't know, between 50 cent and 65 cent. It hit a high of around $5.4. Uh, so that's a 10 bagger. At the peak, not a 10 bagger right now, but that's a 10 bagger. So if you had 5%, and I mean, 10 bags, you know, you can suffer a lot of losers in that case, obviously. And it's like, and take that with, SK Mining. And it's like Goliath. I really like Goliath early on. Took a, pretty sizable position. December. Well, that was my first post at least. December 3, 2020. Stock was trading at, yeah, around, 20 to 25 cents. I actually took a pretty okay position in the financing. I think it was around 25 cents. I mean, Goliath peaked at $1.62. So that's also, a multi-bagger, obviously, with a pretty decent size. Uh, Line one, I got into that one early. I've actually, now recently, which I've stated, I've actually, doubled down quite a bit. But I was in here early as well, March 7, 2019. Okay, it doesn't go back that long. But I think around 30, 40 cents or whatever. Line 1 peaked out at around $2.25. Also a multi-bagger. And note that all of these stories took time. I didn't get a multi-bagger overnight. We're talking, at least a year. At least a year. And now we're at a sentiment bottom. You can see all these stocks are down from the 52-week highs. Every single one is down, and that doesn't matter. It's what comes next, obviously. It's like Irving, and that's obviously down a lot since it peaked out around 4.52. I started. I think I got in, November 2018. That was around here, I guess. So I'm actually down on Irving right now. But before I was down, that was also a multi-bagger. And like you see, it took, at least a year for it. And now they purchased 2 drill rigs, so the story is, transforming again, kind of, like Line 1 is doing. You can only, imagine how many 1% positions these stocks alone have paid for that have gone down. It's like, what I don't get is like, if the more stocks you own, the more stocks will at some point go down. And especially at sentiment bottoms, the more stocks will be down considerably. So if you own 50 stocks, let's say 40% of them are down 50% from the 52-week highs. That's 40 stocks that someone can say, ha ha, you suck. How can you be making money? 40 cases, in terms of recent past. But who cares about that? Are we in the ego business, or are we in the make the best long-term results we can make? I'm in it for, my focus is my long-term portfolio returns. And if you have a lot of stocks and you have like 1 to 1.5% positions, I've had plenty of losers along the way. Some are paper losses that might turn around. But it's like Deep South. I don't actually know really what's going on there. Yeah, what's going on there? Idaho Champion. That's pretty much written that off. Uh, I mean, Prosper Gold hasn't been doing well. They missed in their maiden drill campaign. New Legacy missed on their high risk exploration plays. I mean, there's a bunch I forget, obviously. But a lot of those positions were like, 1% positions, some cases even less, some cases a bit more. And then, you hear, oh, how can you make money, etc. I mean, obviously, you should, like I showed in the hodl portfolio, you should have more money where there is margin of safety and probable growth. That's what I've been, kept on hammering on. That my main strategy or my main focus is probable growth and preferably with margin of safety. So I might have, 5 to 10 times the position in such a stock than I have in one of those, high risk, high octane exploration stocks. And still, that's what I find interesting. It's like, how can anyone be surprised that there's a bunch of losers in this sector? You don't you don't need to have 100% hit rate. It's pretty much impossible to have a 100% hit rate. And the more companies you own, the more companies will look bad at any given time. I mean, I have a bunch of juniors that are down, or that I have owned or still own or whatever, that, down 50-70% right now from the last high. I mean, a bunch of these stocks are down, 50% from the highs or whatever, or were at least. But if you held them long enough and the growth cases are intact and they just keep on growing, the longer you hold, I mean, even though they're down 50% from the 52-week high or whatever, I mean, if you have held them for 2 years and they've grown over that time, I mean, you can suffer through that. And that's what I, keep saying about having a, patience, long-term perspective. And you see it all the time that people brag about some trade or whatever, but how many people do you actually see brag about their portfolio returns? So what's most important, to have actually good portfolio returns, or being able to brag on a single trade, or throw shit at some other guy who's had a bad trade or whatever? I mean, do you know his portfolio returns? The one that, liked the story which went south? No, but most people do it because they feel shitty and they think they'll feel better about themselves by throwing shit at other people. That's what I try not to. I don't go in and say I told you so. I mean, I don't even say I told you so in cases that I'm up a lot in, because I couldn't know that the future would be X or Y. I mean, if I knew that Eloro, at one point in time would be a 10 bagger, let's say, obviously I would be all in Eloro. I wasn't all in Eloro. I have more Eloro now, actually, than I had back then. And there's no guarantees that Eloro will be a multi-bagger from here. Who knows? It's like, I only know that I need a few to make really good returns, and so I can suffer a large amount of losers. And again, if you have let's say you take a small position in a higher risk stock. If that story does well and you don't sell that 1% position might turn into a 5% position, and maybe the case is better than ever when it's up to 5% position, up 400%. So you stick with it, and then it doubles from there. And maybe again, it's like some companies, yes, like SK for example, in my case, that became a larger and larger position of mine because the story got better and better, and the share price kept increasing. So there, it had merit becoming large because the story got better. And like right now with Lion One, for example, why have I doubled down in Lion One? Because the story all of a sudden got a lot better, I think. Still no guarantees. But I wouldn't be completely shocked if in a year or two, line one will be considerably higher than it is today. Or it may not be. I have no idea. But if it is, it's going to pay for a lot of losers during that 2 year period. So I mean, that's what it's like. I don't have anywhere near 100% hit rate, not even close. I have a bunch of stocks that I own that might become something good or might not. And the ones that actually become something, typically I hold on to them so they just become larger and larger and they just keep paying and paying and paying more for other losers. It's like, and again, typically in the high conviction stories, the best ones, I think, I typically have a big precision. So if you have a 5-10 precision in SK, I mean if that one does well, which it has, even better, if you skip the recent past, that paid for every other story I owned. But still, you're gonna see people, you know, oh, you had bad calls, or these stocks were down or whatever. Yeah, and then I just ask them, well, show me your portfolio returns and I'll show you mine. Because this is not a, if this is, if you hang your hat on having very few losers or whatever, I mean, the game is to get the max amount of returns, preferably for low risk. So sure, there's going to be people with way more concentrated portfolios than me that are doing way better than me in the recent past here. But since my position, because it's more diversified, is more tied to sentiment, I'm gonna, with a very low risk, gonna have very outsized returns when we go to the next sentiment high, without a concentrated portfolio. And I think that diversification at sentiment lows makes much more sense than at sentiment highs. Because now almost everything has upside, and when we're at a sentiment high, almost everything has downside. And so it's going to be hard to find. The trick is to find the ones that perhaps shouldn't go down that much. But it's at the bottoms when you can pick up absolute dog shit pretty much that could do like 500% to the next sentiment high. So I mean, I do what makes sense to me. Not everybody should do. Not most people can't stomach doing what I do, being all in all the time, and ride these long downtrends down and up to the next peak, and then down to the next bottom, and then up to the next peak. But the main focus is like you can't, you don't make money off of ego. But a lot of people, typically, I think the ones that aren't doing too well, they like to throw shit at people, basically attack other people's egos. For example, point out, well, you were in this stock that didn't do well. Yeah, okay, sure, and there's a bunch of other stocks that didn't do well either. But if I look at my returns, I'm very comfortable with my returns. So I have see no reason why I should change it. I actually think I'm getting better and better as an investor because I constantly think about investing. Yeah, long-winded rant as always. It's like this is not certainly not a recommendation. I mean, I think I am a bit, well, maybe too top-heavy actually in some names. And I mean, again, many of the big winners, I've just let them do their work, kept them, allowed to grow without scaling back. But there might come a time, any time, where I decide to, well, okay, I'm too concentrated here, or I find a store that's actually, even better, let's say, and I'll scale some. But it's important, I think, that position sizing is incredibly important, and I sure as hell do not have a equal sizing of all my all my cases. Take New Legacy for example. That's obviously a long shot. You have a few drill holes. You have cash for a few drill holes, deep drill holes. You're basically drilling blind. I mean, obviously you wouldn't put 10% in that stock. That's I mean, yes, if if they hit something, you'll make a lot of money. But odds are, of course, that like success is a long shot. That's why you get paid so much when it actually happens. And furthermore, I tend to go into post discovery plays nowadays, and that's where I also jack up the position sizing because the risks are lower. There's typically some margin of safety, and more importantly, there are probable growth, so I get paid to wait on average. Thanks for listening. Consider me biased. A lot of these companies are banner sponsors, etc. Always make up your own opinion, and these are just again some of the success stories. Obviously, there's more companies that have not turned into a multi-bagger, etc. I'm just trying to show that you don't need too many winners to make up for the many losers you will have. And obviously, if you had the same, if you if you put equal amount of money in every stock, the low conviction cases as the high conviction cases, I think that's a bad idea. Yep. Like if you hit the like button if you like my content. Bye.